Today, we are digging into something that quietly costs countless investors a ton of money: the over-trading trap. You know, that impulse to constantly be doing something. It feels productive, it feels like you're in control, but the actual data, well, it tells a very, very different story. And that brings us to the central puzzle we're going to unpack. It's a real paradox, right? If you're the one glued to the charts, doing all the research and making all the moves, shouldn't you be the one who comes out on top? Well, decades of research show it's usually the exact opposite. So let's figure out why. Okay, let's just look at the raw numbers here, because they are kind of wild. A tiny sliver of investors, just the top 10%, are responsible for half of all trading volume. Think about that. This super active group is trading more than once a week on average, while most people, the bottom 80%, are trading maybe 6 times a year. This is where the whole problem is concentrated.
And this gets us right to the heart of the matter. It's not just a theory. There is a clear, proven link between trading that often and getting way lower net returns. It turns out more activity just doesn't mean more profit. In fact, it's usually the opposite.
And hey, this isn't some new idea. All the way back in 2000, this huge study by 2 researchers, Barber and Odian, put it about as bluntly as you can. They called frequent trading hazardous to your wealth. They proved that once you factor in all the transaction costs, the most active traders were consistently the worst performers. So if it's so obviously bad for our bottom line, why on earth do we do it? Well, the answer starts right up here, inside our own heads. We're going to look at 4 key cognitive biases. You can think of them as predictable glitches in our mental programming that basically trick us into overtrading. First up is the big one: overconfidence. This is that little voice in your head that says, "I've got this. I can see the patterns, I can pick the winners and time the market perfectly." It's really the main psychological engine driving people to trade too much, take on way more risk than they should, and forget to diversify. Next, we've got the illusion of control. This is where our brains confuse activity with actual power. We think that by constantly checking our portfolio, reading the news, and clicking buy or sell, we are somehow steering the ship. But really, we're just fiddling with the knobs while the market does its random thing. And this gets so much worse when things are volatile, because the urge to just do something can be overwhelming. And then there's this classic: self-attribution bias. You know how it goes. When a trade makes money, it's because you're a genius, right? Pure skill. But when it loses money, oh, that's just bad luck, or the market's rigged. This creates a really dangerous feedback loop that stops you from ever learning from your mistakes and just pours more fuel on that fire of overconfidence. And finally, we have the disposition effects. Psychologically, we hate losing way more than we enjoy winning. And what does that lead to? It means we cash out our winners way too early just to get that little dopamine hit of a gain. But our losers, oh, we'll hold on to those forever, hoping they'll crawl back to even, just so we don't have to face the pain of admitting we made a bad call. It is a built-in recipe for failure. So here's where it all connects. These 4 biases, they don't just exist on their own. They work together. Overconfidence gets you to pull the trigger. The illusion of control keeps you busy in trading. Self-attribution convinces you you're brilliant no matter what. And the disposition effect just sabotages your actual buy and sell decisions. It's a perfect psychological storm that leads straight to poor returns. But wait, it's not just our own brains working against us. The very platforms we use to trade are now specifically designed to exploit these biases. So now we're going to shift from our internal psychology to the external systems that are literally turning investing into a video game. The industry calls them digital engagement practices, or DEPs for short, and you've seen them. The burst of confetti when you make a trade, the leaderboards, the prize draws. These features are not just for fun. They are borrowed directly from the playbooks of video games and online casinos to maximize one thing and one thing only: how often you trade. And if you're wondering, do these little things really work? Oh yeah, they do. The data is clear. Take something as simple as a push notification. That little buzz in your pocket creates a fake sense of urgency. And what happens? Overall trades shoot up by 11%. And even more worrying, the number of risky trades jumps by 8%. It's the exact same story with things like prize draws. This kind of gamification gets people to trade 12% more overall and pushes them into 6% more risky trades. I mean, these are not accidents of design. They are deliberate behavioral nudges, and they have very real consequences. But here it is. This might be the most telling stat of all. One study found that giving users tiny, practically worthless reward points, we're talking fractions of a cent, caused them to increase their trading by a staggering 39%. That proves this isn't about logic or financial incentives, it is pure psychological conditioning designed to build a habit. Okay, so we have our internal brain biases. We have the gamified platforms. Now, let's add the third toxic ingredient to the mix, the social media ecosystem. A world of constant hype, herd mentality, and an army of so-called finfluencers. And this isn't just a feeling. The influence is very, very real. Research shows that after seeing some kind of finance content on social media, a full 21% of investors, that's more than 1 in every 5, went out and actually bought whatever was being hyped up. Social proof is an incredibly powerful drug that can easily shut down our own critical thinking. And here's the bottom line. There is a direct statistical connection here. People who put a lot of trust in finfluencers are not only more likely to have been scammed in the past, they are also much more likely to be frequent traders. That social validation just feeds right back into the overconfidence we talked about, creating a vicious cycle. Okay, so we've laid out the problem. Our brains, our apps, and our social feeds are all kind of conspiring against us. It sounds a little bleak, right? So what can we actually do about it? How do you protect your portfolio from this perfect storm?
Well, first, you have to build your own defenses. Start by creating a written trading plan. Have strict, clear rules for buying, holding, and selling before you ever put a dollar in. Second, use mechanical tools like limit orders and stop orders to take your emotions out of the equation. Let the system do the work. And third, review how you're doing against a real benchmark, like the S&P 500, not just how you feel like you're doing. This is how you fight back against that self-attribution bias. Now, on a bigger scale, regulators are finally starting to wake up to this stuff. There are actual proposals on the table to ban the most manipulative, gamified features, to legally require platforms to act in the behavioral best interest of their clients, and to force finfluencers to be crystal clear about when they are being paid to promote something. And all of this leaves us with one last really important question to ask yourself. Take a good hard look at the apps on your phone. Is that trading app truly a tool for building your wealth, or is it a game that you're simply the one being played? Because understanding the difference is the first, most critical step to making sure you're actually investing and not just gambling. Thanks for tuning in.